Welcome back to Synaptic Dividends.
Today, we're asking a pretty simple question. Is Coca-Cola's famous dividend a rock-solid source of passive income, or is it kind of running out of fizz? Well, we're going to let the numbers do the talking. Let's dive in.
All right, so to get our answer, we have to start with what I consider the single most important health check for any dividend, the payout ratio. We're looking at the free cash flow payout ratio. Now, that might sound a little technical, but the idea is actually super simple. Think about your own paycheck. After you pay all your bills, rent, groceries, all that stuff, the money that's left over is your free cash. Well, this ratio just tells us what percentage of that leftover cash a company pays out to its shareholders. And, lower is almost always safer. Okay, so when we pull up Coke's latest number, whoa, 174%. Now, at first glance, that is a massive red flag. It looks like they paid out way more in dividends than they actually brought in as cash. How's that even possible?
A number that high would normally be a 5-alarm fire. It basically screams that the dividend is in serious trouble. But with these huge global companies like Coke, you've got to remember that sometimes the headline number isn't the whole story. You have to dig a little deeper. And this is exactly why we dig. It turns out that crazy 174% figure was thrown way off by a massive, one-time tax payment. It's not a regular expense. So, if you adjust for that one weird event, the real, ongoing payout ratio is a much, much healthier 77%. So what's the key takeaway here? The dividend is actually well covered by the company's real cash profits.
Okay, so we know the dividend is safely covered right now. That's a huge plus. But what about its history? Is this a company with a real track record?
Oh yeah, it has a track record. Coca-Cola has one of the most impressive dividend histories you will ever see. They have increased their dividend for over 54 years in a row. That kind of unbelievable consistency earns them the very prestigious title of Dividend King. And this isn't just some ancient history either. The growth is still really steady and consistent, usually hovering somewhere between 3 and 5% a year. That is the kind of reliable, predictable growth that income investors absolutely love to see.
But look, a long history is one thing. The ultimate proof, the real acid test of a dividend's strength, is seeing how it performs when things get really, really tough. So let's put it through the ultimate stress test.
Let's look at the two biggest economic meltdowns of the last couple of decades: the 2008 global financial crisis and, of course, the 2020 pandemic. During both of those crises, Coca-Cola's dividend didn't just survive, it actually grew. They didn't hit pause, they didn't cut it, they kept raising the payout right through the storm. That is just incredible resilience.
So after looking at the cash flow, the long history, and how it performs under pressure, what's the final verdict? Is this dividend safe?
Let's just quickly recap the evidence. We've got a healthy adjusted payout ratio, right around 77%. We have that amazing Dividend King status with a 54-plus-year growth streak. And maybe the most important piece of all, it's proven itself to be completely recession-proof, growing right through the worst crises of our time.
So when you put it all together, a safe payout ratio combined with a long, battle-tested history of growth, the numbers, well, they paint a very clear picture. Coke's dividend, it is absolutely still the real thing. Now, these numbers give us a fantastic snapshot of the dividend's health, but remember, they're only one part of the full investment story. If you want to go deeper and understand the full business model, the competitive advantages, and the management behind these numbers, check out our long-form podcast analyses on our channel, Synaptic Investing.